everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And today we're going to have something a little bit special for you. It's been a little bit of a lull in previewing U.S. economic data. We, of course, had a big run of it already this week. We had job openings data. We had ISM data. We're going to have non-farm payrolls and that big story about the U.S. Employment situation on Friday. We'll talk about that on tomorrow's show. So today, we have an opportunity for something a bit special while there is a bit of space to do it. There's been a lot of conversation recently, and this seems to recur every few years, about the collapse of the U.S. dollar or the replacement of the U.S. dollar as a global reserve currency, the displacement of it by this or that thing, the yuan, the euro at one point. The conversation this go-around seems to be about some sort of a collective BRICS currency or some sort of a collective BRICS effort to replace the dollar. And so what we're going to do is we're going to talk about that and talk about why this is not going to happen, at least in any kind of forecastable sense, why this is not something that we should be expecting, not something that we should be planning portfolios around, not something that we could clearly see happening in most of our lifetimes, if not longer. Let's begin with the most important thing that a global reserve currency needs to be and why it's so important. We begin, of course, as one might, with liquidity. So let's start with one measure of liquidity, market capitalization. This is just the value of all of the money in a given currency outstanding. This is not the usual measure of liquidity, but it's a start that gives us a little bit of a baseline. Why is liquidity important? Well, you need to be able to transact in a global currency. There needs to be enough of it to change hands and to power global exchange. If there's not enough of it, well, then, of course, global economic activity can't happen. You need that medium of exchange. And so clearly you can see here the U.S. dollar doesn't just outstrip any given other currency. It outstrips the BRICS bloc together. It outstrips the Eurozone collectively by a wide margin. So the total value in the dollars that are out there is huge, but this is not the most dramatic. In fact, it's probably the least dramatic way of looking at the dollar's dominance. And the question really then becomes, if you're going to try to come at the king here, the question becomes, well, you and what army? Where is there enough liquidity to power global trade without some sort of cataclysmic collapse in global economic activity if you are not using the currency that has this kind of a lead on liquidity? What exactly are you going to do? What combination of currencies are you going to put together where you get enough agreement in collective monetary and fiscal policy coordination, to say nothing of all the other elements, which we'll talk about here in a bit. But where exactly are you going to get that? What collection of like-minded entities are you going to put together that is going to counterbalance this? And how? Let's leave that open. We're going to ask ourselves that question quite a few times here as we go through. Here's a more dramatic look. This is from the Bank of International Settlements, and this is daily turnover in a given currency. You've surely heard me say before that the dollar accounts for over 80% of global monetary transaction settlement. This is that. Notice, the dollar is not even remotely on the radar of the rest. We're talking about approaching 90%, 88% in the latest numbers from the Bank of International Settlement, and holding at that level now for the better part of 5-6 years. And really holding above 80% for multiple decades. You can see I've highlighted the BRICS block here again. It's barely larger in terms of daily turnover of those currencies than China alone, which tells you that it's really China in that BRICS block that is of any meaningful size. And of course, the euro is more traded, the yen is more traded, the pound is more traded, because China's currency isn't freely convertible across its borders. China has a very rigid exchange rate regime. In fact, one wonders what the yuan actually is, because there's more versions of it than arguably any of the major currencies. There is the onshore yuan, CNY, that's set against a basket of currencies where the dollar is a big part of the basket. There is CNH, the offshore yuan, that's traded out of Hong Kong, not the Hong Kong dollar now, CNH. There's non-deliverable forwards settled in different currencies. There's a whole variety of versions of the yuan. This takes it all in sum. But this is not a freely convertible, easy to transact in currency for global business. Settling one LNG trade between France and China in yuan is cute and all. Makes for a good headline. But when you look at the euro and the yuan here, and you add them together, they barely make up half of the dollar daily turnover. So again, the question becomes, where are you going to get a liquid enough intermediary asset? Where are you going to get a medium of exchange that is going to take the dollar's role here? What even remotely comes close? What group of things remotely come close? It's not there. It's just not there. We can look at depth of financial markets and get a sense of liquidity that way. Here, what I've done is I've looked at the size of stock markets, the size of bond markets, and taken the two together. This is, of course, very important because any kind of economic activity requires the liquidity of these markets to provide credit, to provide the capacity to raise capital, to allow folks to invest in assets denominated in those currencies. Well, very clearly, U.S. markets absolutely dwarf anything else by a huge margin. The BRICS don't even add up to 40 trillion. They don't even make up half of what you're seeing in the US dollar denominated asset universe. Which means all of these various people out there that want to bet on this company or this debt, or that kind of paper, or this ETF, or that REIT, let's say. By the way, I'm not even touching derivatives here. We've not even talked about the futures and options markets. This is just real plain vanilla. If we start to throw derivatives in here, this chart would look even more dramatic. So there is just no world in which the people that want to own assets in this size, the people that want to have allocations of capital to businesses, to government debt instruments, to corporate debt instruments, there is just no way. The paper doesn't exist to invest in those things denominated in non-USD currencies. It's just not there. Where is all that money going to go? And this, by the way, is another hugely important component of liquidity. The currency has to be massive enough that all of the money can go into it without moving it in a really erratic way. If you have a relatively small currency, consider the 2008 financial crisis just by way of an example. And look at that tall U.S. bar there, the collective sum of U.S. Stock and bond markets for a sense. This is obviously where most of the world's money is invested, geographically at least, currency-wise at least. You can see it here clearly with the naked eye. Let's say you get another 2008 type of a scenario. And you don't have to go far. We just had the collapse of SVB. We just had the collapse of Signature Bank. Credit Suisse was just arm twisted into a marriage with UBS. This is not, of course, the '08 crisis, but we are certainly not far away from some sort of credit stress. We've just watched an episode of it. If you had another '08 type of an event, and everybody said, uh-oh, I need to cash out of markets. First, there's a credit crisis. I need to raise cash. Secondly, it looks like there is a recession, some sort of overall crisis outcome here. Let me get away from risk exposure. And everybody cashes out en masse. What would happen if one were to go into the yuan or the yen or the euro? Well, look at the size of these currencies. If you tried to stick that entire tall U.S. bar, or even half of it, let's say it's a movement from stocks to bonds. So let's say you're talking, give or take, 50 trillion. So you try to stick one of that tall yellow U.S. bar into China, into Japan. Well, obviously, those things are tiny in comparison. So if you did that, what would happen to the prices of the currencies there, given that huge mismatch between supply and demand? Well, those currencies would absolutely surge. So all the debts denominated in those currencies would become almost unbearable to service. Any country, business, individual relying on those currencies as the hypothetical replacement for the US dollar would suddenly find transacting in that currency absolutely impossible. Not the case with the US dollar, though, because it is so liquid, because it can absorb flows of this size going back and forth without going too crazy. So this is tremendously important and really the first part of the US dollar's dominance. We've now looked at it multiple ways, but it's unrivaled liquidity. Now, the next level of complication here. We often talk about how the U.S. is so very hobbled because of its twin deficits. And because its deficits are, to a meaningful extent, owned externally. Certainly not to a large extent in relative terms. Much more U.S. debt is owned domestically than externally in sort of percentage of overall debt. A ton of it, for example, is owned by the Fed. But if we look at just external debt, so debt that a country owes to entities outside itself, for the U.S., not even close. Huge amount. This is often talked about as a vulnerability. That's wrong. Here's why. When you are a little country, when you are not the global reserve currency, it is exactly a vulnerability, and that's absolutely correct. When you are the global reserve currency, it's a bit of an issue. But not for you. It's an issue for everybody else. Everybody owns so much U.S. debt that if this debt were ever defaulted on, the global economy would essentially stop. Because number one, if the dollar is backed by nothing except the faith and credit of the U.S. government, right, the definition of a fiat currency, then defaulting on this debt in its massive size would essentially make the dollar worthless. We've just learned here and here and here that nobody is interested in replacing the dollar as the transactional currency of choice because there is just no other option at a comparable level of liquidity. It just doesn't exist. And so no one except the few countries that maybe are disconnected from the global trading system are actually interested in this ever blowing up in the U.S.'s face. It gets worse. If you borrow $50 from me and don't pay back, arguably that's your issue. If you borrow $1 million from me and don't pay back, that's my issue. Consider the scale. Look at how much money the U.S. owes everybody. Now, if the U.S. were to default, let's not even go that far. If somebody were to start selling off U.S. treasuries in size, what would happen to the value of U.S. dollar obligations? They would crash. So all of these people that own all of these debt instruments would suffer crippling losses because of how much they own. Now, is anybody interested in suffering crippling losses on their bond portfolio? At the sovereign level, at the corporate level? Of course not. And so nobody is interested in a collapse. Everybody is effectively locked into a bet going along the creditworthiness of the United States. And this is why the U.S. is able to have the external debt that it has in the first place. Because when you need a safe place to park money, what you end up doing is you end up typically defaulting to treasuries, U.S. government debt, on the assumption that the risk of a default, that the risk of non-payment is minuscule. Not in absolute terms, perhaps, but certainly in relative terms. Which is how you were able to accumulate so much external debt. This is not a weakness. On the contrary, this ties everybody up into a one-sided trade long dollars. Let's look at the other deficit, the external deficit. Here the U.S. shines again. It's not quite as big, and here we're looking at it as a percent of GDP. So the external gap as relative to the size of the economy. You can see that the U.S. is not quite the biggest deficit here at about 3.6%. It's a little bit higher for the UK, but it's certainly, when we consider that this is the percent of GDP, US GDP is orders of magnitude larger than the UK. So the give or take 4% of the US GDP is a much bigger number than the comparable percentage, a little bit higher, for the UK. But the message to take away here is that the G20 average is something like 0.5, 0.6%. For the US, it's closer to 4. Now, why is this a good thing? Well, we just talked about money moving in and out of a country. Consider who would be up to perhaps replace the dollar. We just talked about some of the other countries that show up in the conversation: Russia plus China plus Brazil plus India. China by itself, you can see here, because of course, as we just saw, the BRICS group, when we talk about volume, is heavily skewed to China. If we had just a casual look, let's just say US versus China. China runs a trade surplus. If all of a sudden you had a bout of risk aversion and everybody's money came into the Chinese yuan, let's assume it could, because of course it can't, because of all the restrictions that China places on the flow of capital. But let's say it could. Let's say we live in a magical world whereby China has liberalized capital flows and exchange rates. Even if that were to happen, China doesn't want its currency getting that strong, because exports are a positive contribution to its growth. And so suddenly you now have a policy barrier to the yuan becoming a global reserve currency. Look at the euro, the largest economy in the euro area, or Germany rather, the largest economy in the euro area. Again, about a 4% current account surplus, which means that, again, in simple terms, just to nail down what this is showing you, when you have a surplus, what that means is the world pays you more money than you pay it. In other words, you send more goods and services into the world and get more money back than the other way around. When you have a deficit, you're essentially a consumer more than you are a seller. So the world sells you more goods and services, and you give it more money. So there is a net outflow of dollars as a consequence of this, and a net inflow of euros, let's say, into Germany, or a net inflow of yuan. Well, this, of course, works counter to these currencies becoming liquid enough, because the net flow of liquidity is into domestic markets, not out. So the liquidity of US dollar in global markets is actually reinforced by this. Not only that, it also makes so much of the world dependent on US consumption for demand. And therefore, not really interested in a significant amount of turmoil in the US dollar. Because again, they are inherently bought into a system whereby they need this US deficit because they need to be selling things to somebody in order to have economic growth. And the US's ability to accumulate debt with less consequence than similar debt levels would have elsewhere, because everybody doesn't want to see the US default, because everybody needs a global reserve currency that's viable and doesn't want to see it fail. This dynamic becomes self-reinforcing. Now let's take a bit of a pivot. We know that it isn't so much the problem to accumulate debt. It isn't so much a problem to throw around your economic weight. The problem is if you can't make good on it. So a college student, for example, that goes to borrow money for a house is a greater risk than, let's say, a medical doctor with 10 years of work history. Because the college student doesn't have nearly the income, most likely. We're obviously talking on average here. And ostensibly has a greater risk of non-payment. This is why that college student faces higher interest rates and is able to take on less debt without those interest rates starting to really spiral to reflect the risk of non-payment. Because of this self-reinforcing system that we're talking about here, the U.S. isn't really that kind of a risk in relative terms. And we've talked about why that's scale. But of course, another thing is that the U.S. is able to enforce its economic policy and enforce its economic will. As you can see here, the U.S. absolutely dwarfs everybody else in terms of defense spending. This is the budget as of 2020, and you can see that the U.S.'s ability then to project power, to counter threats, and thereby to remain stable, and thereby to have less risk of a default, is really unmatched. We have a situation in the creation of the euro that nicely captures this. Consider why the European Union came to be. The first three joint communities were European coal and steel, military industry, the customs union, capacity to wage war, European atomic energy, military industry. The European Union, when it first began, the initial points of collaboration and unification were essentially around France saying, look, we're done with the Germans crossing this border every few decades and burning everything. We need control and influence over the German military engine to make sure we can prevent this going forward. Now, there are various studies out there talking about this should have never happened. Sticking all these countries into one currency ultimately doesn't work because you have a central bank that can't manage all these very disparate economies. And that's true. But they went and did it anyway, because the prevention of destructive war is itself an economic good and seems to warrant a degree of imperfection in the structure, or at least they decided that it did. This kind of a mismatch of military strength tells you nobody's invading the U.S. very easily. Nobody's knocking the U.S. out of position whereby the U.S. couldn't respond in an overwhelming way. And so the viability of the borrower and the viability of the issuer of the currency, that is, the durability of the faith and credit of the U.S. government, is defended here by more guns than anybody could muster by a long mile. And so the question once again becomes, what's the alternative? Who's the alternative? Can China, India, Russia, and Brazil agree on enough things to be a military alliance? And if they can even, which is a huge long shot, even just between Russia and China. China and India have a territorial dispute. Russia and China have a territorial dispute. Nobody of the BRICS group has a territorial dispute with Brazil because nobody's attached to it. But even if they could do that, still wouldn't add up to anything close to matching the U.S. Let's take it a step further. Size of Navy. Why is this important? Well, if you have a Navy that's large and able to project power, then you control shipping routes. If you control the sea lanes, you control global trade. And here, I've done this by just thousands of personnel. And again, the U.S. completely outstrips the competition. If you did this by number of ships, you could make the case that China has more ships. But what does that mean? Nobody has more blue water ships. In other words, the ability to project force not just in your neighborhood, but across the oceans. Nobody has that kind of capacity like the U.S. does. It's not even remotely close. And so, if some upstart grouping of countries or some upstart country were to try to say, we are now the global reserve currency, and we are going to ensure that trade is transacted on our terms and in our currency. Again, the question becomes, you and what army? Because you can't defend that system. The story of globalization since the end of World War II, really, but more so, let's call it the 80s and 90s, and the aughts going into, let's call it 2016, where the current deglobalization process really got underway. That whole period of globalization was largely enabled by the U.S. Navy securing safe passage, with some episodic Somali pirate episodes granted, but securing safe passage for global trade, enabling that trade to exist. That's why the dollar is as dominant as it is, in large part. One of the big reasons. Nobody else can enforce a system like that, or even begin to. And so, just on pure arithmetic grounds, the notion that some countries, despite their surely earnest desire for a multipolar currency world, the notion that this is somehow viable, imminent, probable, is just not the case. The numbers simply don't add up. There is no alternative to the US dollar. It is not collapsing. We are not in a world whereby that becomes a realistic prospect anywhere within the forecastable investment horizon. It is clickbait and little more. Now, is this clickbait going to recur again? Almost certainly. But hopefully we can, in the face of such things, look at the data, look at what is actually being told to us in the numbers at a very baseline viability analysis and say, well, there's just no way that this works. How could it? It just doesn't add up. And that is macro money for today. Thank you very much for joining me. I am here Monday through Thursday for Macro Money right after overtime with Chris Vecchio, head of futures and Forex. I'm also on with Chris on Fridays for Futures Power Hour. Not this Friday. We are, of course, off for the Good Friday holiday. We'll be back tomorrow, though, surely. And also on with Tom and Tony for First Call on Sundays. Outside of those, you can catch me on Twitter at Ilya Spivak. Thank you very much, everybody. Hope that was informative. See you tomorrow. Godspeed.